What we got now is we're going to enter into the sort of the VC stage of proceedings here, and we're going to I'm going to introduce a person who's going to do a special presentation here. We have Charles Moldow, who is the general partner at Foundation Capital. Now, Foundation are extremely active in this space. They've made 4 investments, almost $100 million, totaling into Lending Club, Lending Home, On Deck, and Ox Money. And a lot of people don't realize, it was just last week we had the 1-year anniversary of the Google investment into Lending Club. Everyone talks about that as the Google deal. Well, actually, Foundation Capital led that round, and Google just got Google got the kudos because they're such a big name, and it was a big deal anyway. But so anyway, and Charles Moldow his presentation yesterday was referenced by, or Renault's presentation referenced a new term called marketplace lending. That was a term coined by Charles, and he is going to talk right now about how marketplace lending is going to remake banking. Over to you, Charles.
Thanks, everybody. While we're getting this up, you're going to see the title on the first slide talks about $1 trillion market. So I'm a venture capitalist. There's not much that gets venture capitalists more excited than the word trillion. And I was literally trying to think, what would get me more excited as a venture capitalist than $1 trillion market? And I could only come up with one thing, which was if I received a call from one of my CEOs who said, hey, Charles, Google and Facebook are bidding for my company. I thought that would get me more excited. But probably other than that, $1 trillion is a tremendous market opportunity, really for everybody here in this room. That's what we're going to talk about today. One of the things about that I find fascinating about this space is that while we're talking about a huge industry, financial services, and $1 trillion market opportunity for the people here, my sense is that the general marketplace doesn't really get the opportunity staring us in the face. You know, there was an article in the New York Times on Sunday, I'm sure, or Saturday, some of you may have read, that talked a little bit about securitization. But even the Silicon Valley rags aren't covering this market opportunity nearly to the extent that I think they should, which quite frankly is an opportunity for Foundation Capital. But my guess is that other venture capitalists and other investors around the world are going to start waking up to the opportunity. So I mentioned the word trillion, and how do we think about $1 trillion? Trillion's a huge word. The first is I wanted to put a stake in the ground that the industry can rally around. And my stake in the ground is that by 2025, this industry should originate $1 trillion of loans. So $1 trillion is about 1/10 of the global originations. So we've got 10 years to develop, let's see, there we go. We've got about 10 years to develop this $1 trillion market. $1 trillion roughly equals, I'm going to guess, $40 or $50 billion of origination revenue. So that's the revenue opportunity for people in this room. 40 or 50 billion of revenue equates to probably somewhere in the neighborhood of $300 to $600 billion of market cap. So that's it. People in this room, people who haven't even yet started companies in this space, have a $300 to $600 billion wealth creation opportunity. That's a big deal. That's exciting. So another way I thought about this space and how big to think about it is that if we're able to move, give or take, $1 trillion off of the balance sheets of the largest banks in the country, I thought that too big to fail concept, that concept may just go away. The government at some point may realize that this marketplace opportunity is so large that we've removed the risk of those big banks into our economy. That would, again, be a very big deal. So the question is, am I a starry-eyed optimist, or am I just a realist? And really, I'm going to walk you through some data, and hopefully you guys will come to your own conclusions at the end of the talk. And I'd like to believe that I'm the former, not the latter. All right, so by the way, this laptop's not working, so we're just going to be winging it here, which is fine with me. So banks are happy. The banking business is working fine for the banks today. In the 2000s, consumers paid banks $1 trillion of interest. That's great if you're a bank. Not so great if you're a consumer. But with all the money they're making, they still have been cranking back on the amount of money they're lending. In the chart behind me, you can see how they've really tightened the reins on small business lending over the last 5 years. In addition, they've gotten greedier. Over the last 40 years, the net interest spread, which is the spread between what they pay the savers and what they lend out to borrowers, has only grown. Today, that spread is 13%. That's the largest spread over the last 40 years. So it's both no surprise that the banks are happy, and it's also no surprise that consumers aren't really happy with their banks. So this chart is the Net Promoter Score for banks. I think I'm the fourth presenter in the last 2 days to show this chart. And the only point I'll make is that when you look at the number of people who are proponents of banks and the number of detractors of banks, clearly it runs in the negative category, and you can see it in that small slice of red. But just know that big banking has the same Net Promoter Score, give or take, as utilities and telcos. Right? That's certainly not the world that marketplace lenders want to be in, and luckily the Net Promoter Scores of companies like Lending Club are, rather than being in the teens, are up in the 60s, 70s, and 80s, which is great. So as much as we all in this room dislike banking, the millennials, the generation of the millennials, really dislike banking more than even we do. I quite frankly don't even know why that's true. But look at some of the data here. 33% of millennials don't even think they need a bank. 70% think that they should get banking from the large internet companies like a Google or an Amazon or an Apple. Nearly half think that banking will be reinvented by startups. And that really is somewhat of a rallying cry for people in this room because they're asking for new products and services. They're asking for us to invent and reinvent this business, which is, I think, as an investor, very exciting. So let's just review for a second. We have a market in the trillions. We have incumbents that are pretty universally disliked. They've got products that are somewhat outmoded, and they're pretty bad at services. They're expensive, they're inconvenient. So all we really need is some spark, some enabler that enables us to take advantage of this unique opportunity. To me, it's really a perfect storm. And that's really this opportunity that you all face in the industry, is how do we take advantage of the perfect storm facing us today? So if we step back just a little bit, in 2006, we all know somewhat of the history of peer-to-peer, and I first heard about it, I think, in early 2008. And it's kind of a cute moniker, peer-to-peer, you know, kind of I'm lending to some other person on the other end who's maybe going to do a home remodel or pay off some of their credit card debt. But to me, it's very difficult to build a $1 trillion industry around this concept of peer-to-peer. And quite frankly, peer-to-peer doesn't even describe it anymore. Right? I think Peter mentioned that there were 50% of the people at this conference represent the investor community. So really, it's today peer to retail investor, high net worth individual, home office investor, small institution, bank, insurance company. It's peer to all of them. That's not peer-to-peer. That's peer to something else. And so we really do need a new name to refer to this industry. So after having lunch with Renaud and chatting about kind of his very big vision for creating a new asset class, it kind of encouraged me to come up with something. And so at first I thought, well, how about disintermediated lending? I hear that term sometimes. We're trying to disintermediate the banks, get the banks out of the equation. Well, it didn't really work for me because, quite frankly, marketplace platforms aren't disintermediating. They're also sitting in the middle. They're intermediating. So you can't disintermediate if you're an intermediator. And they provide a really valuable service because today there's a concept in Silicon Valley that we often refer to as Marketplace 2.0. And the concept is that we have marketplaces that are adding value in the middle of a market. So take Uber, who's curating the driver community, or Airbnb, that's curating and helping the people who have inventory match inventory with renters. And then the same thing with marketplace lenders like Lending Club and Prosper and others. They're actually matching their credit scoring, their servicing. That's intermediating. So disintermediated, that just didn't get there for me. And so really what did get there for me was marketplace lending. And to me, marketplace lending can be a hundreds of billions of dollar asset class in the exact same way that asset-backed lending, securitized lending is today. And if we want to move away from the cottage industry of peer-to-peer and kind of fulfill the destiny of this $1 trillion, we need to step up our game and become this kind of next generation of legitimatized asset class and financing. So let's take a look at marketplace lending. Some of you have seen this before. This is a study that was done by McKinsey. McKinsey basically came out and said, okay, marketplace lenders have, give or take, a 400 basis point advantage over brick and mortar banks. Like no matter what brick and mortar banks do, because of the cost structure of those banks, there's 400 basis points that can be handed out to the borrowers and the lenders in marketplace platforms. That's great news. Borrowers win, savers win, and it's a lot more convenient. The reason I know that marketplace lending is more convenient is that if you go look at the UK market and you study RateSetter and Zopa and the others, they actually don't have a rate advantage over their competitors. In the UK, the primary competitor is a supermarket. Like I thought when they said this to me, I thought, oh, it's like a financial supermarket. They're like, no, 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 it's like a grocery store supermarket. The actual competitors are supermarkets. And the supermarkets offer rates that are roughly the same as Zopa and RateSetter. But yet these guys are growing like gangbuster. Why is that? Well, it's because convenience. So here in the States, we have the luxury of both being drastically cheaper and being vastly more convenient. And that's amazing. So speaking of convenience, the other day, I thought, let me just go and check out Wells Fargo and a couple other banks and see what it would be like to take out a loan online. And literally, I got to this page on Wells Fargo. I cut and pasted it right into the presentation. At this time, I'll read it. At this time, Wells Fargo only accepts online applications for a personal loan from customers with an existing account that has been open for 1 year or more. However, I may go to the bank and apply in person. That's so nice of them. Thank you very much. I really, really appreciate that. But you know what? I'm busy. You're busy. Parents are busy with kids and homework and carpools. Small business owners are busy. People don't have time during the day to go to a bank and apply for a loan, particularly when you're all offering that opportunity to them online, at night, whenever, 24/7. That's convenience. That's great for our industry. So how big is the opportunity in front of us? So I talk about $1 trillion. That's loans originated. And at Foundation Capital, we did an exercise some number of months ago to really identify the opportunity in the space. And you see a bunch of circles behind me. These circles represent the revenue associated with each of the markets identified, from consumer at the largest, all the way down to merchant cash advance at the smallest. In case you can't read them, merchant cash advance, payday, purchase finance, student lending, small and medium-sized business, real estate, and consumer. So $870 million of origination and fee revenue every year associated with these 7 markets. Now here's what else I like about the slide. You'll see that there's a green circle. Okay, that green circle represents the amount of that $870 billion broken out by vertical that each one of those today generates via online sources. So for example, the majority of payday lending happens online today. So that's already, I would say, evolved and moved. But if you look at real estate and consumer lending, and like the data actually is in the slide, you cannot even discern a green pixel in those circles. Like that's the actual percentage of market share that Prosper and Lending Club and all the others added together account for within this industry. And I find it very ironic because last night I was at a dinner hosted by someone here at the conference, and I met up with another one of the large VC firms here in the Valley. And I said to this person, wow, I've not seen your name associated with any marketplace lending deals. Why is that? And he said, oh, you know, we love the space, but we're too late. I'm like, too late? Like, you haven't seen my bubble chart because clearly you're not too late. We've barely penetrated these markets. And I think that's a challenge for the venture capitalists in this industry and for the entrepreneurs who are trying to get money, which is on the one hand, they don't understand how large the opportunity is and they think you're too late. On the other hand, if this is truly a multi-trillion-dollar market in revolution, really the opportunity is just beginning. At least that's how we see it. So at Foundation Capital, we look a lot, obviously, at this space. We've thought a lot about the space. And we really have 4 maxims that we like to think about when evaluating marketplace lending and the opportunities for marketplace lenders. I just want to quickly bounce on each of these. So the first one we call data, data, data. And to some degree, it is all about the data, right? We like to say sometimes that we want our companies to out-FICO FICO and to be fairer than Fair Isaac. It's kind of a phrase we use internally. And what do I mean by data? Well, there are the obvious sources of data like income and past payment history. That's easy. We all know that. The banks use that. The marketplace lenders use that. But then there are all these new sources of data. There's social reputation. There's location-based data. There's community participation. There's duration of email address that exists. There's a whole bunch of data points that the new marketplace lenders are including in their models. And those data points, some of them are quite predictive. And let me just give you one of my favorite examples. Okay, this is a slider. This slider you can find on many marketplace lenders today. And it really represents, typically, the choice that the borrower has between some small size loan and the largest size loan. And the idea is you move the slider, and it tells you both how much you can borrow, and on the other hand, what your interest payments or what your monthly payment would be. And the marketplace lenders that I talk to tell me that good borrowers will sit there and take that slider and they'll move it to the left. And they'll think, no, I think I need more money. And then they'll slide it to the right. And then they'll look at the monthly payment they need, and they'll think, oh man, that's a hard payment to make. And they'll slide it back to the left. And they'll spend a lot of time deliberating on where that slider should end up. They say there's another bucket of borrowers who come to the website, hit the slider, and they just slide it right to the right, all the way to the right, like give me everything I can get. And if you think about it, who would you rather lend to? The person who's really deliberating, or the person who just says, give me everything I can get? And we obviously all know the answer. And that's why data like this heuristic data on website behavior and lots of other data is really valuable. Now, I will say one more thing about data. Data is really valuable, but data without models is virtually worthless. And I was trying to describe this to my wife the other day, believe it or not, and we were playing Words with Friends, and I said to her, you know, data without models is like if I were to play you in Words with Friends and it were in French, and by the way, I don't speak French. Like I know all the letters, but I have no idea how to put them together. And that's really what you end up with, data without great models. The second maxim is really all about connections and liquidity. And it's really important for companies in this space to both be matchmakers and to be market makers. Meaning you need to have a very good control of the flow on the borrowers, and you need to have good control on the flow on the lender side of the equation. And matching that, being that matchmaker and market maker is really actually quite difficult. So here's somewhat of a generic slide that represents, in the blue, think of them as new borrowers, and the green, think of them as borrowers who are stepping up and taking out a new loan. Now, one of the things that I think is not necessarily obvious to investors when they look at this space is that marketplace originators, if they're good, are both lending to new customers and making new loans to existing customers. An existing customer who you've already paid for is a really profitable opportunity for you. They've paid down some principal, they've proven themselves as a good credit risk. Why not go out and offer them a new loan? Why not say, hey, you borrowed $10,000 from us, you've proven yourself to be a good borrower, you only have $6,000 left, let's do a refinance. Let's offer you $15,000 and let's lower your rate. That happens all the time, and by the way, that's good business. That's a really profitable transaction. But as investors, we have to be careful because when marketplace lenders talk about originations, they're talking about new and existing. And in our business, it's kind of like a SaaS company that talks about new sales bookings, right, and renewals. And they're all bookings, but quite frankly, new sales bookings are way more valuable than renewals. And then the same thing for marketplace lenders. When you're evaluating these platforms, make sure you ask and understand the question of how many of those customers are new borrowers and how many of those customers are borrowers that are just being turned again. Now, on the lender side of the equation, there's one chart that we like to see, and we call it the money slide. And the money slide talks about lender flows into an originator. And it's really quite simple. If you look at annual cohorts, every year, year after year, what we want to see is that new borrowers that come onto the platform originally invest an amount of money that's greater than the cohorts before them. Meaning, hey, 4 or 5 years ago, maybe somebody would have written a $1,000 check to go onto Lending Club. But now the Lending Club model is understood, the data is great. Those original check sizes should be not 1,000, but 2, 3, 4, and 5,000. And then in addition, the slope of those lines should be accelerating because what we want to see is lenders reinvesting interest and principal. That'll get you the standard slope. Then we want to see them writing more checks onto the platform. That'll get you a steeper slope. So this is called the money slide in our vernacular, and we'd love to see slides that look just like this. And by the way, this was taken from Lending Club. Thank you, Lending Club. So the third one is marketplace platforms are neither easy to start nor to scale. And I will talk very briefly. So you see on this slide a lot of regulation, okay? So we're investors. We'd like to think about barriers to entry. One big barrier to entry is navigating this set of regulation. I'm not going to dive into it too deeply, but needless to say, when you take the regulatory hurdles and the matching both sides of the marketplace, supplier and borrower, and you talk about data and scoring, and you realize how hard this challenge gets. All right. So the last one we say is that marketplace lenders should be built not just to disrupt, but to displace. And it really speaks to business models. And the primary point that I want to make is that marketplace lenders have a very fundamental decision to make. And that decision is whether they want to be a balance sheet lender or a marketplace lender. And it's a very fundamental decision that both speaks to how they need to build their business and ultimately how they exit their business. And I won't go into it too deeply, but what I will say is that Wall Street has voted, and Wall Street tells us exactly what the right answer is. On the one side, you can see today the multiple valuations of marketplace companies, roughly 11.1 times revenue. On the other side, you see traditional fintech lenders at roughly 3 times revenue, okay? I would much rather be a marketplace lender and receive 11 times revenue multiples than I would be a specialty finance company receiving 3 times multiples. So for us to invest, we really want to see a marketplace phenomenon rather than a balance sheet phenomenon. So I went about and spent a bunch of work and put together this paper that we officially launched today, but Renaud mentioned it yesterday. I'd love for people to go download it and read it. It's meant to be really a living document for this industry. It's for all of you to comment on, provide feedback. We'll continue to turn the document. We'll track the new platforms that we learned about. We'll track the new phenomenon. And we look forward to kind of the discourse that will occur as a result of the paper. You can find it on Foundation Capital's website. So just in closing, what do we worry about? Do we worry about the banks waking up and competing? And the answer to that question is no. In this slide, you can see the productivity gains that banks have achieved over the last 4 years. 70% of banks have achieved 0 productivity gains. Now, maybe that would be okay generally speaking, but think about the last 4 years. Cloud computing, mobility, virtualization, these are fundamental technology improvements that have driven industries, and yet the banking industry has not been able to take advantage of them. So we don't worry about banks being competitive. We also don't worry about banks acquiring because banks trade at 1 times revenue. You marketplace lenders will trade at 10 times revenue. That's dilutive to banks. They really can't go out and buy their way out of this problem. So people have long thought about the internet being overhyped. I will tell you right now that this industry, this multi-trillion-dollar opportunity, is absolutely not being hyped enough. That's our position. We have voted with our wallet. We've invested roughly $100 million in 4 marketplace platforms. We're very excited about our portfolio. We will continue to invest in this space. We look forward to continuing to evaluate companies and see companies. We're excited to be here, and we really appreciate the time that you've given us. Thank you very much.